So here's something that nobody tells you when you're getting started in real estate. Rental properties are not the default best option. It's definitely the loudest one. Most beginner investors have never even done a side by side comparison of what a rental actually costs versus what a raw land deal costs in time, money, stress. So that's exactly what we're going to do today. We're going to focus on real numbers, not hype. And by the end of the video, you're going to know exactly which one makes more sense for you where you are right now. So if you're new here, this is the land method. We teach investors how to build real lasting wealth through vacant land and through raw land acquisitions. No tenants, no contractors, no 2 a.m. maintenance calls, just a smarter, more direct path into real estate that most people have never been taught. So in this video, what I'm going to do is I'm going to do a complete breakdown of raw land versus rental property, the ROI or return on investment, the effort, the startup cost, the cash flow, the taxes, and which strategy is actually right for you. I'm also going to cover the 5 biggest mistakes that investors make when they come from a rental background and start buying land. Stay to the end because this section alone will save you some very expensive learning experience. So let's start with why most beginners default to rental property and the hidden costs that most don't mention. So rental properties is what people are talking about. It's what your family mentions when you sit down with them and see them once a year, right? Those family members you hardly ever see. It's what every beginner real estate course leads with. And there's a reason for that. Like, it's familiar. You buy a house, someone pays you rent, you build equity. The concept makes sense and sticks with you immediately. But there is something that those pitches or those discussions usually leave out. See, the average rental property investor deals with a vacancy rate of 5 to 8% per year. On top of that, property management runs from 8 to 12% of your gross rent if you outsource it. If you don't outsource it, then you got to deal with it. Maintenance typically costs 1 to 2% of the property's value annually. And that's in a good year, honestly. If you add insurance, if you add in property taxes, and then the occasional capital expense, and by capital expense, they're big, new roofs, HVAC, plumbing, your actual net yield will compress down to maybe 4, 5, 6% in a competitive market. Now, that's not to say that this is reason to never buy a rental property, but it is a reason to ask whether you're actually comparing it to anything before you're committing to it. Most beginners haven't, and that's the gap that we're filling today. So let's get into that. Let's compare raw land versus rental property. We're going to do a side by side on the ROI and the effort comparison, and we're going to use real numbers to do it. So we're going to put the both strategies, and we're going to put them on the same table, okay? So a typical starter rental property in a U.S. secondary market, say a single family home at $180,000. Now that's a very low end home, but again, it's just a rental property. It's a small little thing, right? So $180,000. That's going to require a down payment somewhere in the $36,000 to $45,000 range if you're financing it conventionally. Now, you'll spend time screening tenants, managing maintenance requests, and handling turnover. Your time cost is real, it's ongoing, and it's going to just continue because when you're dealing with a property like that, it's not people that stay there, right? It's a constant turnover, constant movement, things like that. Now, a starter raw land deal in the same type of market, well, you can acquire a 2 to 5 acre parcel for much less, $8,000 to $20,000. There's no tenant to manage. There's no structure to maintain in that case. Well, what about the returns? Obviously, right? Because we're not just investing. We're not just talking about outlay. We're talking about what we get back. Well, land purchased below market value and resold to a retail buyer or a developer or an adjacent landowner can generate 50 to 500% returns on capital in a single transaction. Now, that's not a guarantee, but it's a realistic outcome when you're buying right. And I'll talk about some of those deals as we're going along here. Now, rental property, on the other hand, builds equity slowly over time. Land, when acquired right and done methodically, that can produce these returns in a much shorter window, even instantaneously. So both work. There's no doubt about that, right? But the effort to on that return ratio is dramatically different between them. And that's especially important for somebody that's just getting started, because you don't want to give yourself a bunch of headaches and a can of worms and basically talk yourself out of ever doing anything before you even start. So let's look at why wealthy investors are quietly accumulating raw land. And again, why most people are overlooking it. See, there's a reason that Bill Gates is one of the largest private landowners in the United States. Ted Turner recently passed away, but there's a reason that he was as well. In fact, his goal was to be able to ride his horse, have enough land to ride his horse from the Mexican to the Canadian border without ever leaving his own property. Right? There's a reason that institutional money has been quietly moving into raw land and rural land for the last decade or so. And it's not because they don't know how to buy rental properties, right? These people know what they're doing. Land is the only asset that cannot be manufactured. You can't build more of it, right? You cannot replicate it. And because it lacks the curb appeal of that renovated flip or that narrative of that rental income stream that we talk about, it stays under the radar. That undervaluation is exactly where the opportunity lives for all of us. Now, for everyday investors, the advantage is even more direct. Land has no depreciation in the traditional sense. It doesn't break, right? There's no liability exposure from tenants. Holding costs are almost zero. Literally, it's just property taxes. And on rural land, we've had properties that we just paid a tax bill. It was $37, right? And maybe up to a few hundred, depending on the value of the property. But they're very, very, very low. Now, wealthy people don't get together and talk about their land portfolios at dinner parties, right? But they just keep accumulating it. And that silence is part of what most retail investors never consider it as a wealth building vehicle. But now that you know that they do it and that other people do it, that is why you should, right? So let's talk about that no tenants, no repair, no contractor advantage that we get with raw land investing. Let's be direct about this because it doesn't get said clearly enough, right? Every problem specific to rental property ownership, people with late rent, people moving out, evictions, property damage, people talking about mold, code violations, contractors not showing up, emergency plumbing repairs that always happen at 2 a.m, all of these things, and so much more, right? Every single one of these problems disappears when that structure is no longer on the property. Raw land is inert, right? It doesn't leak. It doesn't need a new water heater. There's no appliance to replace. There's no tenant relationship to manage. You own the parcel, you hold it, or you sell it. That's literally the entire operational scope of land. Now, for investors with full-time jobs, families, or ones that just prefer simplicity for whatever reason, this distinction is enormous. We talk to investors every week who spent years managing rentals before they discovered land. And the most common thing that they tell us is, I wish I discovered this years ago. This is not a marketing line. It's literally just the structure of what this asset does. And when you're comparing effort adjusted returns, the real metric that matters, right? How much effort you're putting in, land wins by a wide margin for anyone that values their time. So let's talk about why this is important, how to buy land for as little as a few $1,000s. Because one of the biggest objections that we hear from rental property investors is this, right? Land sounds interesting, but I don't have enough capital to get started in it. They're thinking about leveraging and what happens with rental properties and things like that. So again, that objection is based solely on that rental property assumption that real estate requires a big down payment and a bank. You're focusing on market values of property. So there are thousands and thousands of landowners around the country that have zero knowledge of their properties and are just looking to liquidate them. You just need to find these people. You are creating equity in the property right from your offer. So for example, I just put a property under contract for $18,000. That's our purchase price that we are listing it for $65,000. And I'll break that down in another video, but this is a real world current example. So if you do not have the money to purchase that, there are other options as well where you can now buy and sell that property at the same time without ever using your own capital. So there's no financing, there's no bank approvals, there's no credit checks, there's no 20% down, there's no waiting years and years and years to build equity and then walk away with some sort of profits. Now, this is common in rural land transactions because many sellers of raw land have owned the parcel for years. They have no mortgage on it and they simply want to liquidate it rather than paying taxes for something that's not even near them and they're not even using anymore. For buyers, it means that you can acquire multiple parcels with the capital that would cover a single rental property down payment. So that diversification and the dramatically lower capital barrier of entry is why land investing is genuinely accessible to beginners and people that have very lower amounts of money to work with. So it's not just a talking point, it's something that actually structurally works for real estate investing. So I told you that we would talk about 5 mistakes that first-time land investors make when coming from that rental property background. So let's get into that. So if you're coming from the rental property investing and you're starting to look at land, there's 5 specific mistakes that we can see over and over repeatedly from people. The first one, mistake one, is applying rental property valuation logic to land. Land doesn't appraise like a structure. Comping it works differently. Comparable sales must be recent, they must be local, they must be of similar acreage, they must be of similar access. So you can't use the same valuation that you do with housing. Another mistake 2, is ignoring utilities and access. A parcel that has no road access and no utility easements is much harder to sell than one that has both. So this is something that you want to verify that you have before you buy it. Now, obviously, if it's on a street, power poles right there, things like that doesn't matter. But when you start getting in, if it's a landlocked property and things like that, we still deal with those, but you have to verify that information and know how to deal with it. Mistake number 3, assuming that all land in the zip code is equivalent. It's not true. People are like, oh, this is a great zip code. And it may be. It may be a good zip code to invest in, but topography, flood zone status, soil quality, zoning, those can actually make 2 parcels that are adjacent to each other worth completely different amounts of money. Mistake number 4 is over improving the deal mentally in your own head. Real investors are trained to see potential and underwrite renovations, right? For rental properties we're talking about. In land, your margin comes from buying right, not from adding improvements. So you need to know your numbers going right in and what it's at. Mistake number 5, this is a huge one, is skipping due diligence and title research. Liens, easements, back taxes, ownership disputes, these are common in rural land. Obviously, also just finding out certain things about the property that you didn't know. So really making sure that you have that clean title search and making sure that your due diligence is thorough. It's a non-negotiable. If you avoid those 5 things, then you've already separated yourself from almost every first-time land buyer that's out there. So let's talk about those things a little bit. Let's talk about zoning, land use, due diligence, what to check before you buy raw land. And due diligence on raw land is different from due diligence on a rental property. There's no inspection report. There's no roof to access and inspect. What you're really evaluating is the land's usability, its legal standing, and then its marketability, what you can do with it. So you want to start with zoning. What's the parcel zoned for? Is it agricultural? Is it residential? Is it commercial? Is it mixed use? This determines what the future buyer can legally build or use the land for, which directly impacts your exit options on the property and the resale value of it. We talked about access a little bit, so you want to confirm this as well. Is the parcel on a road? If not, does it have a deeded easement to a public road, or is it landlocked? See, landlocked properties are more difficult to sell unless you negotiate access as part of the deal, or you're selling to somebody that understands that's what they're buying in for a very specific reason. Again, we still deal with these, but we know that going in. It's not something we discover later. You also want to check the FEMA flood zone maps. A parcel that's the majority of it is in a flood zone has buildability restrictions and can have a significantly reduced buyer demand depending on the area. Right? Not necessarily on a coastline where everything's like that, but not great to be in a flood zone in the middle of rural America in most cases. You also want to verify your back taxes. Realizing that delinquent taxes follow the land, not the seller, is important, right? You realize that these need to be paid when you close. So if you're getting a great deal on a property, but it's $10,000 in back taxes, who's paying those? You need to understand that and you need to know what's going on, because if you don't, the whole deal could blow up at the closing table, or you could be getting a whole lot less or paying a whole lot less for the property because now those are included. And finally, you want to make sure that you run a title search. And better yet, in most cases, use a title company or an attorney to do this. The cost on vacant land is usually very cheap for this, a few $100s to $1,000 in most areas. And it could be the most important money that you'll spend on the deal, again, especially if it's one that has some value, because they're going to see things that you don't about the property. Now, this process that I'm talking about, it may sound a little complicated, but it's really all that there is. So it's very learnable, it's very repeatable. Most investors complete a full land due diligence checklist in under a couple of hours per deal after they've done it a few times. So it's very simple to do this over and over again. So then the big question is, well, how can you generate cash flow for all land? Rental properties have tenants. So how can you do it without tenants? And this is the most common pushback that we hear from rental property investors in this, right? Land sounds great, but I want monthly income. How do I do that with a piece of dirt? And that's a fair question. And the answer is more varied than most people expect. The top way that it generates cash flow is by selling the property while holding financing to your buyer. So for example, with the property I mentioned earlier, what if I got a $15,000 deposit and then I financed $50,000? If you remember, I'm buying it for 18 and selling it for 65. So we're buying it for 18,000. So with a $15,000 deposit, I'd have almost all of my capital back. And then I would be getting almost $500 a month for 20 years on a property like that. So in less than a year, all of that's profit, right? And what does that mean? It means that I'm making $500 in actual cash flow each and every month for over 19 years. And we've done this over and over and over again throughout the years. You become the bank. You collect the monthly payments with interest. No tenants, no maintenance, just payments. And this is just an example. I'm not sure I'm going to do this on this property. Again, I'll break it down in another video as to what we actually do with it, but that's just showing you what can be done. And there are other options as well. Hunting, recreational leases are out there, timber rights, grazing leases for ranching, solar leases, agricultural leases. These are all additional options that create cash flow and that could be viable depending on the location and the land type. Now, for land near growing suburban areas, selling to builders, selling to developers at a premium, that's a legitimate exit strategy. And that in turn doesn't generate cash flow, but it generates these lump sum returns to you. So you're infusing yourself with a capital at that point. The key insight here is that land cash flow looks different from rental cash flow. But for investors who want simplicity and margin, that trade-off is often well worth it. And in reality, you can make more monthly off a piece of land than you can per a house, because if you figure in all the expenses that you have to subtract on a house, those don't exist for land. So it is just all cash flow. Let's talk a little bit about tax advantages and compare raw land investing versus rental property depreciation strategies, because that's another big one, right? So taxes are where a lot of investors make the mistake of defaulting to rental property because they know about depreciation. And depreciation's real, don't get me wrong. We use it. It's a meaningful tax benefit. But it's also more complicated than most people realize. Rental properties allow you to depreciate the structure, not the land. And they allow you to do this over 27 and a half years. So that creates a paper loss that's offset by that rental income. But when you sell, depreciation recapture applies at a 25% tax rate on everything you've claimed. So many investors are surprised by that bill. Now, if you get into a different structure and you move things around, there's ways around that. But if you don't, you're going to be paying that money at some point. Now, raw land, on the other hand, it doesn't depreciate. But that's not necessarily a disadvantage. When you sell land that you've held for more than a year, gains are taxed at long-term capital gain rates. And if you're using a 1031 exchange, you can just roll those proceeds from one land sale into another, and then they're tax deferred. Now, for investors like myself that are operating through an LLC or an S Corp, land flips on installment sales can also be structured to manage these ordinary income exposures. And we're able to do that a lot with a lot of write-offs and things like that, which are completely legal, and the way you want to structure your business when you're doing a number of different properties. And the point of this, what we're saying here, is not that one strategy is more tax efficient than the other universally, right? It's just that land has a legitimate underappreciated tax profile that works well when structured correctly. And most investors have never even had that conversation because they never invested or even considered in land in the first place. So this conversation I had with my CPA, he actually was interviewed here. You can watch his video. And we talk about this a little bit in that, but it's somebody like that was going to help you in those situations. So does this mean that raw land is actually right for everybody? Nobody should stick with rentals? Well, we're going to be direct here because this is actually the most important part of the video. And it's something that almost no one in the investing space will say out loud, but I have no problem admitting it, right? Raw land investing is not the right strategy for everyone. If you have significant capital, if you have strong property management systems, they're already in place. If you're in a high appreciation market and your rental yields are strong, then I'll give you the legitimate argument that you should stay doing those. You should stay in rentals, right? We're not here to tell you rentals are bad. They are a proven wealth building tool. Again, I do use them myself. But land investing tends to be right if you're a beginner, if you have limited capital, if you want a lower barrier of entry, if you're an active professional or just an active person who doesn't have time to manage a rental portfolio and you don't have the pieces in place to have somebody else handle it for you. If you want higher potential returns on capital deployed and you're willing to learn the due diligence process that we outlaid, or if you want a genuinely passive hold strategy with almost zero holding costs, then land is something you want to look at. The investors who struggle with land are typically those who expect it to be a fully passive model from day one without the educational work, or those who apply the rental property thinking to a completely different type of transaction. And I want to tell you something, the only reason that they do that is because they hear that's the case with rentals, which isn't even true either. Rentals are not fully passive from day one. So knowing which category you're in before you commit to a strategy will save you years of frustration and thousands, tens of thousands of dollars. So what do we cover today? Rental properties definitely have real value, but they also have real hidden costs in time, capital, and complexity that most people jumping in never see coming. That's why more people quit than follow through in this, right? 90% of people that get into this don't ever go anywhere with it. There's your reason for that. Raw land, when you approach it with the right methodology, the right mindset, it offers a dramatically lower barrier of entry, a genuine no tenant, no repair, no operational profile. It does give you cash flow strategies like we talked about and a return potential that competes seriously with anything in residential real estate. In fact, it exceeds it in many cases if done right. We compared the numbers side by side. We covered seller financing. We talked about due diligence, zoning, taxes, the 5 mistakes that you have to avoid if you're making the transition or just starting. So here's my question to you after all of this. Hopefully you've stayed on. Hopefully you watched this. Hopefully you found this educational. But I want to know in the comments right now, drop it in there. Are you currently investing in a rental property, raw land, or are you still deciding where to start, or are you looking at transitioning? I read every comment and I'll respond as well to each and every one of them. So drop in the comments below very simply and just let us know where you are. And if this breakdown that I just did gave you something useful, then make sure you hit the subscribe button. We publish new land investing strategies, deal breakdowns, market analysis multiple times per week. No fluff, as you saw, no guru content, just what's working right now in the current market. So if you want to go any deeper on this, then watch the next video. There should be a link right here on your screen. And I'll see you the next time with another breakdown just like this. Have a great one, everybody.